Today I'm going to respond to Benjamin Tal's recent piece about Canadian real estate. I'm also going to speculate about what Benjamin Tal might have said back in 1637 if he was a tulip analyst just before that market crashed. It seems to me he doesn't understand that more data doesn't necessarily lead to better analysis. And I'm going to talk a little bit about Canadian real estate in general. And I'm going to close the piece by talking about why banks are just other economic actors. They don't necessarily have your best interests in heart. I have to confess that I don't actually like talking about Canadian real estate very much. Of all the topics in Canadian finance, it's the least interesting to me. I'd rather talk about things like convexity, duration, pick apart a financial statement, but I also like debate about financial assets of any kind, and it's in that spirit that I'm going to respond to Benjamin Tal's piece. Now, although Tal is calling for a 10 to 15% correction in real estate prices, he spoke to this group of Canadian real estate agents recently in a way that, according to a friend of mine who saw him speak, was actually quite bullish. First of the comments that apparently impressed a lot of the realtors there was that you can't count cranes and use the number of cranes in the city of Toronto, for example, as a method of analysis, because many of the cranes that have gone up are commercial cranes. In reply to the no cranes argument, that's fine, no problem. We can't use cranes when talking about why Canadian real estate, specifically condos, are overpriced in Toronto at the moment. Maybe Tal will tell us next time that we can't talk about the number of cars that are driving down the street in Toronto at a certain time of day or on the weekend. Migratory bird patterns, the number of donut shops in Toronto. These are all interesting smoke screens, but they're not relevant to the underlying issue. We can talk about the fact that the economy is doing badly. It's an anemic economy. Our low interest rates are tied, for the past 14 years, have been tied to a couple of countries who are about to face an economic demographic time bomb, which is going to turn them from being net providers of credit into being net recipients of credit. That's going to do things to interest rates, specifically make them rise. Real estate might become untenable for a lot of people. Okay, so we can't talk about the number of cranes, but we can talk about the macroeconomic background that's going to drive interest rates globally and therefore locally. The other argument he made is that the green space that's been legislated around the city of Toronto means that, we've now limited the amount of space that people can build on, and that will have an impact on prices. That's a ridiculous argument. As I've said in other videos, you could fit the population of the planet in the state of Texas. There's more than enough room to build in the city of Toronto or in the Greater Toronto area still. So the argument that housing prices should remain buoyant because of this new limitation put around the city of Toronto, it's a smokescreen. Canadian real estate is a risky bet at the moment. It comes down to the fact that we know. We don't speculate, we don't believe, we know that interest rates are going to be rising at some point in the future. When that happens, the idea of holding hundreds of thousands of dollars of debt presents risk. We're not compensated for taking on that risk. First, we don't believe that real estate is going to be rising much more in the future. Canadians are already, in a sense, tapped out. And second, because we don't know about how much interest rates are going to be rising in the future, we can't forecast the future. Renting gives you an optionality that owning and being tied to hundreds of thousands of dollars of mortgage debt doesn't give you. And when I say optionality, it means that prices in this city or employment in this city dries up, you have the option to move on to somewhere else in a way that tying yourself to a mortgage with interest rates as a giant question mark out there that really affect your economic life. The risk-reward trade-off for most people just isn't there. Now, getting to the piece that Tal actually wrote, he mentioned that price-to-rent ratios and debt ratios hide more than they reveal. It seems to me that he's making an argument that just so happens to back up his employer's book. Tal, as an economist, is obviously familiar with something called the law of one price. The law of one price says basically, if I can rent a space for $1,500 a month, or I can have a mortgage on a place that costs me $2,500 a month, at some point those prices are going to have to converge. They have to sort of come to one price. Otherwise, the people who are spending in a sense too much on mortgages are going to figure, okay, well, I'm spending $1,000 more than I need to on my mortgage. I'm going to start to rent, which is going to drive up renting prices, which will lower mortgage costs, and so on. That's the principle of law of one price. Tal's familiar with it. I'm not a huge advocate for it. When it comes to housing, it's quite relevant. Most disturbingly to me, though, is the fact that Tal doesn't seem to understand that more data does not lead to better analysis. It's like, ooh, sounds really impressive. Sounds like without all these data points, without answers to these questions, Without the Excel spreadsheets that the bank holds like it's precious close to its chest, you can't comment on Canadian real estate. To point out the fallacy of that, I'm going to actually use an extreme historical example. Suppose what Tal would have said if he was a tulip analyst back in 1637 in Holland. What was the florin value of new bulbs grown in Holland in the last 3 months? When looking at all the players in the tulip market, how many are highly levered elsewhere, have ships abroad bound for Araby, and how many are more well capitalized here at home? How many tulip traders are hiding from their brokers who need to mark these assets to market? How many people are buying into a greater percentage of their tulip portfolios versus the number who are keeping their leverage relatively high? Can we disaggregate the nature of the Semper Augustus market and the debt loads carried by those fine people from the dregs who trade in the more ugly colorin? What price do the moneylenders offer for tulips now, and what do we expect in the future? What are the alternatives to tulips on the market at the moment? How many other types of flowers are available to bulb speculators? How many non-Dutch are buying into our tulip trade? These are all relevant questions, or would have been relevant questions to Benjamin Tal back in 1637 before the tulip market crashed. It doesn't really matter. Many of these questions don't really matter to the underlying idea that an asset can be morbidly overpriced, and if you are paying attention to the nitty-gritty details, oftentimes, to quote one of the characters from Fight Club, you're polishing the brass on the Titanic. I think back in 1637, Tal might have said, you know what, we can't answer these questions about the number of foreigners who are buying into the Dutch tulip trade, and therefore we shouldn't even try to speculate, or you can't speculate on the tulip value or the value of the tulip market unless you have answers to these very, very obscure but maybe relevant questions. He would have said that just before the tulip market collapsed. More data does not lead to better analysis. As an economist, Tal should know that. I'd also say, talking about the lack of data that's available only to the banks and not available to average Canadians is the most cynical form of smokescreen, a strategy that I believe talks up the bank's book or make the banks seem more relevant or powerful than they actually are. It does very little to help Canadians, those people whom the banks purport to serve as clients. So what you need to do, you need to first understand that the bank is not necessarily your friend. They are just another economic actor whose interests don't necessarily line up with yours. I used to work at one, and I have stories that would curl your hair of incidences where the bank is obviously not your friend or not the friend to the Canadian consumer. Stay tuned for some of those stories. Also, your real estate broker is an economic actor who is just looking after her or his own economic interests, and they don't necessarily line up with yours. Next time I'll be talking about the wild west of the unregulated insanity that is the Canadian brokerage profession. I know some of you are real estate agents, and I look forward to your responses to that piece.